With Temu facing tariff uncertainty and a competitive price war, is now the time to buy PDD stock? Hi, I'm John from ValueGlance.com. I've worked as a research analyst on an 11-figure fund. I have a PhD in theoretical physics, and I'm the author of the book Stop Checking the Price, where we talk about how to find high-quality companies that win in the long run. So today we're going to take a look at Pinduoduo, ticker PDD, and see how the quality, value, and growth trends compare over the long term. Pinduoduo, ticker PDD, is the Chinese e-commerce giant behind Temu, the discount shopping site that's been rapidly expanding all over the world. The company's strategy feels like the early days of Amazon, where they give up short-term profits to invest heavily for the long term. That means R&D, that means logistics, and that means relationships with merchants. The company's stock price exploded more than 450% in the early 2020s during the COVID-19 pandemic and the e-commerce boom. However, it dropped 80% in the following year. Since then, the stock's been choppy, at least for the last 2 years, and the company's most recent earnings report warned of future volatility in profits to come. The nonsense news has focused on headlines about US tariff policy and competition and a price war with other e-commerce giants like Amazon and Mercado Libre. Now, as long-term investors, we shouldn't get caught up in the nonsense news headlines. Instead, let's look at key quality, growth, and value trends to see what the long-term fundamental data is telling us about this stock. So here we are at ValueGlance.com taking a look at PDD. And we're plotting the ROIC, shown in blue, compared to the weighted average cost of capital, shown in orange. And we see it is shaded green when the ROIC is above the WACC and red when it's below. So remember, we want an ROIC that is high, steady, and ideally increasing when compared to the weighted average cost of capital. That means the business is creating long-term value. So we see that PDD achieved profitability and maintained strong and steady quality, with the most recent quarter coming in at 23% ROIC compared to a 7% cost of capital. Now we can go ahead and add in the invested capital. And by looking at the trends of invested capital and ROIC, we can see if this business is compounding for the long run. And indeed, we see exponential growth of the invested capital plotted on a log scale. So this is telling us that the business is increasing its invested capital by reinvesting profits and putting that money to work by maintaining a high and steady ROIC. So this is the fingerprint of a compounder stock that we've encountered before. Over the past 5 years, we see the invested capital grew at a whopping 62% CAGR, compound annual growth rate. 62%. And revenue, if we want to go ahead and plot that as well, we see that has grown at 70% CAGR over the past 5 years. That's the up and to the right growth that we like to see. However, we should always keep in mind the possibility of exponential rollover when companies reach a massive scale. So from this ROIC-IC relationship, we see that the business has maintained steady ROIC while invested capital has increased. So that's quality, but what about the value? So here at ValueGlance.com, we can click on value. And what we're plotting here is the hype factor, shown in green, compared to the equilibrium hype, the long-term median, shown in pink. The hype factor is basically the market price for the invested capital divided by the book price. So it's similar to a price to book, and it gives us an estimate for how much the market is willing to pay for the invested capital that business can put to work. This ratio can be thought of as the acquiring cost multiple that the market is willing to pay for the company's invested capital. We see that since the 2021 crash, the hype factor has been in a slump and it's been below the equilibrium hype. And if we jump to today, we can see a current value of the hype factor at around 3.4x. So we can compare that 3.4x with Amazon's hype factor of 5.5x. Again, an e-commerce giant, that gives us a comparison. Now we can also go ahead and plot free cash flow yield. So this gives us a sense of how much free cash flow the business is generating compared to the share price. So think of it as a percentage, as a yield, based on free cash flow. We see that free cash flow for last quarter came in around 8.9%. And if we jump to today, based on changes in the price, we see that free cash flow around 7.5%. So we can compare that free cash flow yield of 7.5% for PDD with Amazon with a free cash flow yield of 0.9%. So that gives you a sense of how much cash the business is generating. Now, we talked about Amazon before. When a business has low free cash flow yield, it's not necessarily a bad thing if the company is reinvesting that cash flow into growing the business, more capital assets, more invested capital, so that it can create future value. But we see PDD not only has rising invested capital, at its current price, it has significant free cash flow yield. So putting these pieces together, we see a quality business that is growing its invested capital and seems to be at a favorable price point. If you read the nonsense news headlines, tariff uncertainty, a competitive price war, a race to the bottom, it all sounds scary. But as long-term investors, we want to look at these long-term trends and look at real fundamental data to analyze businesses. Now remember, no one can predict the future, especially in the near term. But by looking at these long-term trends, we can avoid the nonsense news and the hyped headlines. So keep investing for the long term and keep compounding knowledge.